This financial reporting and analysis forms almost 20% weightage for our exam, right? And the readings are also big in number, almost 14 readings are there. And even from the next level perspective also, it adds a lot of value. There are two aspects in it. One is the reporting aspect, where the focus is on reporting mechanisms like GAAP and IFRS. And the second one is an analysis aspect. How do I understand the financial statements? So the two perspectives clubbed into a longer chapters. We'll have a few weeks spent exclusively on these, and this being a big weightage chapter of the subject, it's always better to complete it early so that you can start the practice of it early itself. Now, the first few chapters are purely theoretical in nature, which explain why do we need to do a financial reporting, why do we need to do a financial analysis, what's the difference between these two, something like that. Whereas from the fourth chapter onwards, the focus moves more close towards, okay, how do you understand the profit and loss statement? How do you understand the balance sheet? So an in-depth chapters into each of these aspects. How do we look at the cash flow statement? When I do a financial statement analysis, what are the key things I do? And there are chapters exclusively towards each element, some of the key elements of the financial statement. One chapter exclusively driven towards inventories. One chapter exclusively driven towards income tax. So like that, there are so many chapters that have come out where the initial part, first couple of chapters, they are quite simpler in nature in terms of they explain you only the basic conceptual or theoretical aspects of the need for financial statements and financial reporting. And even towards the last, we have a couple of chapters which talk about the common frauds which people do in terms of manipulations of the financial statements. How do you interpret, how do you find out or trace those kind of frauds and all those, right? So, yeah. So, when we are starting off, our first objective is to look at what is financial reporting and who use it. Financial reporting is more of a standardized form of presenting your data. Let's say there are thousands of companies and all of them have shareholders. All these companies which are listed on exchanges, they have their shareholders. Now these shareholders, they need to understand how the company is performing. So some key data about the company, both operational aspects and what the company has borrowed and what the company has owned, these kind of some of the summary of the financial performance of the company needs to be known to almost all the shareholders. Not only shareholders, it should be known to various parties, even someone who is lending to the company. Banks assess this financial statements of the company, or even the investors do assess, and for that matter any other suppliers, vendors, they also look at how good is the performance of this company. So the company has to present the data to all these people in a format which is common across, and that is where bodies have come forward and set standards on how the data has to be presented. What should be treated as revenue? How should we input numbers into revenues? How should we look at expenses? Which of them are called as operating expenses? Which of them are called as non-operating expenses? Like that, they have defined a set of rules and said, finally, whether it is Infosys, a software company, or DLF, a real estate company, or Ranbaxy, a pharma company, whosoever presents their financial statements, the format should be one and the same. And the meaning should be one and the same. When they are saying revenue, the revenue for the meaning of revenue or the what items go into revenue should be the same both for Infosys as well as Ranbaxy as well as DLF. When someone is saying this is my net profit, I should not say I have done it as A minus B. Someone else saying no, I have done A minus B minus C. Then, though you are using the word net profit, I cannot say your profit is better than others, because you have used a totally different formula to arrive at your net profit. So the reporting, what it does is it brings about this kind of standardization in the presentation of the financial statements, right? So whenever we talk about a financial reporting framework like that, every country has its own framework. India has Indian GAAP, generally accepted accounting principles. US has US GAAP. Now every country is following its own standards of presentation. That is what has created a problem for cross-country transactions. And that too, today we are in a world where a company in country A takes over a company in country B. Now consolidation of the financial information of both the countries is always a difficult task, because this is following in its own format, this is following the reporting in its own format. Now clubbing is a big issue. That is where a need has come for the IFRS format, International Financial Reporting Standards, which is globally accepted kind of a standard. So globally they are trying to design some kind of presentation mechanism so that when we say presentation, even the content will be the same. So when we are talking about operating expenses, A, B, C, D, E, F, G, H. These are the H elements, 8 elements that should go as a part of operating expenses. Now, as a company, you find out what are your operating expenses, depending on your business. Whether it is so even cross-country comparison becomes more easier when we are going with IFRS kind of a mechanism. So, the financial statements are really important. And the consistency of financial statements is the way in which the financial statements need to be presented is what we call as a financial reporting mechanism. How that financial statements are presented to the user is what will go as a part of and the financial statements are interpreted by almost a good number of parties. Shareholders interpret it to make sure whether they want to continue the investment or they want to sell off their shares. Banks will look at the same statement to think whether this company should be given more loan or reject the loans. Or probably the vendors will think, whether this company can, whether we should extend our credit limits to this company, or we have to collect everything in cash payments only. All these various stakeholders interpret the financial statements of the company, and it will talk about how well the company is performing or how it has changed over the past. Right? Compared to last year, what was the improvement? Compared to last year, where were the areas where the company has fallen in performance? All these things can come out just by looking at the financial statements. So, as an analyst, our job is to get a very thorough idea of the financial statements of the company. So when I say financial statements, 3 key statements. One is a profit and loss statement. We'll talk about each of them because there's one chapter exclusively for each one. So the one statement is a profit and loss statement of the company. One is the balance sheet and one is the cash flow statement. These are the 3 key financial statements of the company. We have a chapter each for each of them. So as an analyst, I need to have a thorough understanding of these 3 statements. Right? The more and more I am able to dig through the statements, the more and more conclusions I bring out through the statements, the more and more I can give investment decisions to my clients in a more effective manner. So why should I do the analysis? One, it helps me to decide which company, which securities are good for buy, which companies are good for buy, and it helps me even for my own buying as well as for my recommendations to my customers. It helps even the banks and other creditors and everyone, and even in M&A it plays a very key role. At what price I should purchase this company? If A wants to acquire B, at what price is worth to acquire B? Right? So those kind of things are clearly understood by the financial statement analysis. So you assess the past performance of the company. What we do in financial statement analysis is we assess the past data of the company, probably last 5 years. Look at the balance sheet, profit and loss statement and cash flow statement of the company, and based on the past data I make some kind of predictions about the future of that company, right? So as we are saying, okay, now how do I differentiate these three statements? Balance sheet, profit and loss statement, cash flow statement. Simple put, profit and loss is all about the revenues and expenses the company has made within the financial year. From April 1st, 2012 to 31st March 2013, whatever was the revenue the company has got and whatever the expenses the company has made and what was the profit. Of course, what goes into revenues, what goes into expenses, we look at them in detail under the respective chapters. But as a summary, it's nothing but what the company has revenue, what are the revenues of the company and what are the expenses during this year and what was the profit. That's so it talks about operations of the company. Revenues is because of operations, expenses is because of operations. So it all talks about the what did the company gain or lose during this particular period. Whereas what the balance sheet talks about is at the end of the period, which means as on 31st March 2013, what is the position of the company? It's not bothered about 1st April to 31st March. It's more bothered about what is on 31st March 2013. What does that mean? As on that date, there is still something outstanding. Something outstanding to be received, outstanding to be paid. Let's say the company has taken a loan for 5 years, right? On April 1st, 2012. It will not make the payment, it will not pay back the loan as on 31st March 2013 because it will pay it somewhere in 2017. Right? So as on 31st March 2013, that loan is still outstanding to be paid by the company to someone else. Right? Or similarly, if the company is having, if the company has purchased some big assets, right, a big plant in 2012, a machine in 2012, by 31st March 2013 it's not of zero value, it will still have some value existing. So when we talk about the financial position, what are still left which will give benefit in future, right? If I still have a machine with me, probably I'll produce something more, or even if I sell it, I'll get something. Worst case, right? So that is something that will give benefit to me in future, right? It could be a building, it could be a machine, it could be all these things, right? Or some things, let's say if I have given some credit to my customers, which I have not collected as of 31st March 2013. It will give benefit to me in the next financial year. So wherever there is outstanding to be received means either literally in the form of cash or in form of benefit. Right? If I have invested in a machine today, the outstanding to be received is in the form of benefit. So if I sell it, I'll get it in the form of cash. But if I use it, probably it is, without any extra spending, I can very well use it. So that's also a kind of a benefit. So the balance sheet simply talks about what is outstanding to be received and outstanding to be paid as on a particular date. Outstanding to be received are called as my assets. Outstanding to be paid are called as my liabilities. So the income statement or profit and loss statement is more bothered about the period, whatever has happened during this period. Whereas the balance sheet is more bothered about at the end of a particular period or as on a particular date. As on a particular date, this is what is outstanding to be received, this is what is outstanding to be paid. So that's the definition of a balance sheet. And then we have a cash flow statement which simply says, if at all, see in this profit and loss statement, there are some accounting rules that come into picture. Simple example I'll tell you, we'll deal in depth slightly later. The simple example is, let's say I have purchased a machine for 1 crore. Right? Logically speaking, my expense should be 1 crore for this year because I have spent 1 crore. But if I assume, but that machine will have some life, right? That 1 crore is not for 1 year. Probably I might have spent 1 crore thinking that it will give benefit for 10 years. I can use it for producing some items for next 10 years. Right? Then what the accounting rule says is, though you have spent 1 crore, don't put 1 crore as your expense. You put only 10 lakhs as your expense because you are using it for 10 years. You put only 10 lakhs as the expense for the year. So obviously if you put 1 crore, your profit is much lesser. But if you are putting only 10 lakhs, your profit is much higher. Right? So that is where the need for cash flow statement comes into picture. Because the profit and loss statement is prepared based on some accounting rules. Whereas the cash flow statement, it's a full-fledged real transaction. Because cash is a real entity. I need to have it either in my pocket or in my bank account. Right? If I say there is a movement of cash by these many lakhs or crores, I need to see that cash either in my pocket or in my bank account. That's a real world. Whereas profit is not a real world term. Profit is probably, you can call it as an imaginary term also. Because profit is prepared based on so many accounting rules. So profit is not same as cash. When you say I got a profit of 1 crore, I cannot show you 1 crore in my bank account. Sometimes it could be more, sometimes it could be less. Because one example which I have told you, though you have spent 1 crore, you did not spend 10 lakhs to your customer and to your vendor. To the person who sold you that machine, you have given 1 crore. But in your expense, you are showing only 10 lakhs. You will show it as 10 lakhs for the next 10 years. Then it is becoming 1 crore. But you are showing it as 10 lakhs for the next 10 years. So at least in the initial few years, your profits are looking much higher. But the same is not translating into cash. So there is a possibility, though you are profitable, you may end up into a cash flow crisis. You may be profitable because are prepared as per, again, that IFRS and regulations and standards are coming into picture in preparing the uh, profit and loss statement. But cash flow statement is all about reality, right? My profit may show 1 crore profit, but for doing my transaction, the profit is not sufficient. I need to have cash. If cash is not there, I have to do one more borrowing. So cash flow statement talks about the real movement of cash, whereas profit and loss statement is a notional side, which will talk about profit when all which based on some accounting guidelines. So that's where finance guys are more bothered about a cash flow statement. They are not much bothered about a profit loss statement. Profit and loss and balance sheet are more from an accounting, what you call consistency perspective. Right? From a consistency standpoint, across multiple companies, which one is more profitable compared to the other? From that evaluation standpoint, both profit and loss statement and balance sheet are helpful. But if the focus is more on the real presence of cash, am I going cash rich or cash crisis, cash surplus or cash deficit, I may have to look at the cash flow statement itself. So that's where evaluating these three statements are very much required. And we have even a mechanism which says this one can be derived from these two. If I know the full-fledged balance sheet and profit and loss statement, I can derive the cash flow statement, which means if you say the two prime statements, these are the two prime statements. If I have the profit and loss statement and balance sheet, see, profit and loss statement is during the year. What happened during the year?